So this is the Monday Multifamily Freedom Chasers Asset Management Zoom series. Today we'll be going over managing risk in multifamily real estate. For those who might be new or unfamiliar with this platform, this is the Multifamily Freedom Chasers. We are an online community. We believe that financial freedom through apartment investing is possible and feasible because we are doing it. This particular program is hosted by Bibi and I. She's in Dallas, I'm in Massachusetts. We're both moms. She's been in asset management for over a decade, and we both jointly own assets together. Reach out to us, we don't bite. Those are our social media handles, our emails, etc. Let us know what questions you may have. Would love to hear from you. And then the Multifamily Freedom Chasers also has a WhatsApp group. We are on Facebook. We also have a WhatsApp group. All these sessions are going to be recorded and placed onto our YouTube channel, and I think it streams on Spotify as well. So grab the link by scanning that QR code. I will try and drop it in the chat, but I think everyone that's on here is already within the WhatsApp group. All right, enough blah blah from me. Let me stop sharing. Let's see. Bibi, there was another one of you. Are all your profiles hosts, or are you all set? So you're muted.
Is there another Bibi here?
There was. I thought I.
Yes, I took it off.
Oh, you took it off. Okay. All right. So
Yeah.
then you good?
Yes, I'm good.
You
Let me
ready to
just.
start? Okay. Awesome.
Can you make me a co-host? Okay, rename.
I thought I did. Oh, I guess not. Here you are.
Okay, good. Hello, everyone. We are here again for another episode of our asset management series. So this time around, we're just figuring out what to be discussing while the year wraps up. But today I decided to discuss multifamily risk because most of us are active and also passive investors in multifamily. So it's important that we identify what is risk and how we can mitigate them. The purpose is for you to understand that every investment, even non-investment, is also a risk. It's a risk if you're not investing. It's a risk of you losing your money to inflation. It's a risk of you losing your money to buying things that are irrelevant and all that. So not doing anything on its own is a risk. But now investing in multifamily is not a bed of roses. We've all been I don't know, recently we've all been tuned into hearing very good things about multifamily, but most people are not discussing about the challenges or the risks that are involved in it. So today, I'll be addressing some 6 different categories of multifamily risk that you need to identify and weigh the option and see if it's something that you should still continue to do on a deal. The first risk I want to share with us today is the financial risk. No, let me share my screen. So you can see my screen, right?
Yes.
Yeah, so the first risk I want to discuss today is the market risk. Let me explain what that is. It's for you to understand the economy fluctuation and know how the market is reacting to the multifamily. So if you've listened to some of my videos, I talked about when you are buying a property, some of the things you need to identify or look at before you narrow it down to, okay, yes, this deal is good for me. And one of it was the market. So before you buy a property, there's the market risks involved. And lately we've seen that happen. The market risk we've been seeing happening is the inflation. We've seen inflation taking a serious hit in the American market, and that has really affected a lot of things. We've seen labor go high. So invariably, if you're supposed to do capex on some items, maybe you're supposed to cost $40, we are seeing it double or triple because due to the inflation. So market risk is a very, very important factor that you need to look at. How is the market reacting? Is this a good time for me to buy? Or is it a good time for me to sell? Is it a good time for me to manage? Is it a good time for me to build? We've noticed that building, people that are doing new construction, since last year, they slowed down on the construction project. It just recently, I'm seeing the construction project coming up again. And that's because maybe interest rate is coming down. But when you're about to do a new build or new construction, the market plays a very large factor. You need to identify factors like your interest rates, because remember, this is a bridge loan. It will keep going high if the interest rate is not fixed. You need to also consider the labor that will be involved in it and the material cost that will be involved in it. And not just that, apart from the market risk, another thing you need to consider is how is it affecting employment? How is it affecting relocation? Okay, when I mean market risk again, I'm talking about, you can see people migrating. For the last 2 years, we've seen people migrating from different states to other states, maybe due to low cost of living, due to they just like the policies or the law in that state. Now we're even seeing people leaving states because of abortion rights and all that. So these things, you might think that these things do not affect acquisition or exiting a property. They play a direct effect on your deal on multifamily, because really multifamily is without human beings or without people, there's no multifamily. So it's really dependent on the people around it. So these are things you need to understand when you are these are the risks involved in buying a property. That's why you have to do your market research before that is the first thing you need to narrow down on before you do anything. Now, the second risk is the tenant risk. And what does that involve? Now we are seeing that, okay, now there are new policies coming up as we have a new president coming, and his first job that he said was going to do on day one was to start deporting people. Do you know the number of illegal immigrants in the country? There are so many, and these people, they are not living under the bridge or they are not staying on the road. They are staying on some of us on our apartments. Truth be told, they are in some of the apartments that we currently have. So these are risks that are in multifamily, and you need to also address. Some tenants, they might have a loved one that is illegal and will have to leave the country, and for that reason, they might have to all relocate back to their country. And we're also seeing companies downsizing. We're seeing people losing their jobs. Like a month ago, unemployment rate rose to about 4.3% or 4.1%. Last week, I think it was 3.9, 3.9 or 4% is very high. 1% of any unemployment is about 1.67 million people that are employed. So you need to know that tenant risk is very real, and it can happen through different ways. The policies that are going to come on, they're going to affect some of your tenants. You need to consider that. I know that it's people are losing their jobs. It's also going to affect your rent collections. There might be high delinquencies. You need to see how that factors into your business and all that. The next one is operational risk. We are seeing this play out significantly. Operational risk is basically comes from whoever is managing your operations, and the person managing your operation is the property manager. We've seen unseasoned property manager or inexperienced property management company And if you're not on top of it, their inefficiency can affect your entire 1 year or 2 years, or in short, your entire business plan if you do not kick them out on time. So you need to, there's some markets that we have uncooked, unbaked, property management company. It's very difficult for you to get good property management company in some markets. So you need to be very, 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 very careful. Are you ready to train and groom them? Like one of the markets we are in, we had to groom. There were lots of issues about getting property management company in that market, but we had to get the worst of the devil. Let me put it that way. And we had to train the worst of the devil to become what we wanted. You understand? So there's some markets like that you don't get the kind of quality property management company you're looking for and all that. So you need to weigh that factor as well, because if you don't have the right people managing it, then you're in trouble already. You might end up flying down every weekend to see what is going on your property, and you don't want to be doing that. That's not the idea of multifamily at all. So let me see. It's not moving. Okay, the next one is the financial risk. I explained this in the last episode we had. No, before the one we had that we won the property management team, not that episode. I'm saying the one before the one that we won the property management team. The one that we were discussing capital stack. The financial part of a deal is very crucial, and people don't really understand it. Most of the deals that are falling apart, like there's a deal that I invested in with a friend. It's not my deal, it's somebody else's deal. I invested with her years back and all that. They did a short sale. The deal was bought for 15 million, and they sold it for 10.5 million. So 4.5 million was lost in this deal, So, and it was due to financial risk. How do I mean? They took a bridge loan, and the bridge loan was due July this year, and they overbought the property. They bought it too high, so it was not hitting the refinance amount. In order for them to refinance, that means they have to bring money. That means they have to do some cash call from their investors. So they called all the investors and asked for cash, and the investors said no way. They were not going to fund it and all that. And that was as a result of this alone, the risk there was as involved of the debt, the loan on it. So you need to understand what kind of debt is applicable right now. There's nothing wrong with bridge loan. Please don't get me wrong. It's a very good way of exiting from a property. Like if you want to stay you have a value add, like a big value add property, you want to change the roof, you want to do so many things. And after doing it, the property is going to increase value. Bridge debt is the best debt for you to do, but you need to understand the market. That's why I started first with the market. You need to understand the market. What market are you playing at that point in time? So for a market that is low, like the interest rate was at 0 2 years back in 2022, 2021, that was a very wrong time for you to take a bridge loan, because you know that is the worst or the best it can ever be. The next thing that will happen is that your interest will start going up. So if you study the market and you have a deal, that would not have been a good time for you to have taken a bridge loan. Now, in this kind of market where we are, this is the right time to take a bridge loan. Let me tell you why, because we are up here in the loan level, as an interest rate is this high, and right now the Fed is bringing it down gradually. So going forward, the interest rate has gotten to its peak, it's coming down. So if you've taken a bridge loan at this point, that means in 2 years when you're refinancing, it's going to be somewhere here. So that means the debt you're refinancing from is going to be lower than what you started with. But rather, people were going from when it was this low, they were collecting bridge debt at the lowest point, and interest rates started going. And that means when you're exiting, you're going to exit at a very high interest rate. So that was the problem most people are having. So you need to understand the financial risk when taking a loan. That's one. Another one is the leverage. How much leverage are you taking? Those things can also affect your deal. It can affect your cash flow. It can make you indebted. You'll not be able to pay off all the loan you owe, and it can make your property unstable. So financial risk is very, very key. You need to understand it. Legal and compliance risk. So I forgot to mention this. One of the reasons why they decided to sell, apart from having the loan issue they could not refinance, was they had a lot of compliance issues. So when you buy a property, yes, it's possible that you bought a property, and because every year the city, I'm in Dallas, I don't know about any other market, but in Dallas, when you buy a property, every year the city comes to do a random inspection. They want to see if you're in compliance. But guess what? The more you own a property, the more they're losing up on you being compliant. But the moment that property is transferred to a new owner, they take the standard this high. So something that the previous owner was able to avoid, issues the previous owner was able to avoid, a new buyer will not be able to avoid it. You will go through the entire process. They will go through your entire property. They would do a thorough inspection and come back with legal and compliance issues that you need to face. And some of them you might not be able to solve, some of them you might be able to solve. So when you're doing your inspection, doing your due diligence, these are things you want to identify. What are the major hazard compliance issues that I know I'm going to face? Are these big issues? Is it worth buying the property, or is not worth it? Or can I put it under my CapEx budget and rectify it once I buy it? So in this case, in the property I was referring to, it was beyond them. It was a lot of money they had to spend to be in compliance with the city. So that was one of the reasons why they had to sell and all that. So legal and compliance issue are real issues. You need to know what are imagine you buying a property that maybe is not zoned, it's not properly zoned. Maybe it was not, maybe it was for business, and somehow they were able to make it a multifamily, and the zoning effect came into play and all that. Then you should know you're in trouble. So property code, zoning, these things are real issues, and you need to check them before you buy. Then the last one is exit strategy risk. Some of you will be wondering, how is there any risk in exiting? Yes, there are large risk in exiting, and the risk involved in exiting is you need to identify the period. Like I said, the market is around the entire thing I just mentioned. The exit rate, you need to identify how is the market at that point in time. Is it a good time for me to sell? Is it a good time for me to refinance? Is it a buyer's market? Is it a seller's market? Should I hold it a little longer? These are questions you need to ask. At the time of exit, you're like, oh, my capital gain is a lot. If I exit, I'll be slammed with a lot of taxes. Do I want to do that? Or should I exit at the end of the year or at the beginning of the year? These are questions you should be asking and all that. And you don't just ask those questions. You can ask them with your CPA, your accountant, to know when is the right time for you to exit and what you can do to exit properly. Because if you don't exit properly, you'll be slammed with a large tax returns, especially if you've made large profit, capital gain on the property. So these are questions you need to be asking and be talking to the right people and know the exact time to exit. Earlier this year, I gave you guys an example of a property that was they wanted to sell for 11 million, and that was in the 2021 or 2022. They wanted to sell, no, 2022. If you're laughing, they wanted to sell for 2022, 11 million. And the guy was in best and final. I was at 10.5. Another person was at 10.8. We're just two people at competition. So two of us wanted to buy it. And all of a sudden, the seller came and said, I'm not selling. I want to wait out the market. I will sell 1 year after. Okay, we left him. 1 year after, they brought back the property. Guess how much this property was worth? 9 million. Even 9 million was like, it was not an interesting deal. Like, you have to just take it and just say, okay. So you have to understand the market to know when is the right time for me to exit. If not, you might lose money or you might gain money and all that. So that is for that. So now the next thing I want to talk about is
So
I
Bibi,
want
let me ask you an example. So
yeah.
to the people in the room, how are they looking at these market trends, or where should they be looking at these market trends so they don't become that seller?
Oh yes, the market trends right now it's still a seller's a buyer's market right now. And the reason why that is because of the interest rate, and secondly, the economy. And thirdly, some deals are under the water, so they just want to exit. So we have a lot of properties outside than buyers at this time. It's not something that will continue for too long. In 2 years, once the interest rate comes down and all that, I don't see that happening. So if you want to buy, I think there's a time for you to buy. And some of you that listen to podcasts, this is the time to buy. You've been hearing it and hearing it. This is the best time for you to buy. And that's the truth. And because it's the buyer's market now, before we know it, once the interest rate comes down and all that, it might become a seller's market. And that would be the right time for anybody to sell at that time. Once that happens, once interest rate comes down and all that, it's a good time for you to refinance. It's a good time for you to sell. So the market, studying the market at every point in time is very, very important. Okay, so now these are some examples I was able to bring out to see so that we can relate with it and understand it furthermore. So one example of the market risk is economy downturn. It can lead to vacancy. So we saw that happening, like I said, let me reiterate. We saw that happening recently. Inflation came in. Some people even said we're even in recession. Some people don't believe we're not in recession and all that. So we are both in inflation, recession as it is and all that. So that is really, really affecting the market. So you need to know it and know how you can mitigate it. And how can you mitigate it is for you to conduct a market research. So you have to look the market you are going to. It's possible the market was good this year. Does not mean that it's good. It's good next year. We saw markets that were high like in 2019, 2020. When the pandemic came, we saw people moving from some location to the rural areas, some to very isolated areas, and that was because of the pandemic, and some of them never returned, and that alone made some shift. We saw some locations having declined population. So you need to conduct your market research. It's not a one-off. Market research is not a one-off. Maybe I just bought my deal, I'm done. It's something you do every year so that you can take informed decision. So like this year now, we've conducted on the two markets we are currently in. We're in the Dallas market, and we're also in the Pennsylvania. We've conducted the market research on both. And that was because we're doing our budget. We wanted to understand what the market is saying versus our budget. So in the process of doing that, we have to do the market research. And doing that, we understood that things have changed. Last year, we were able to increase rent for our Dallas market, like anyhow. But this year, sorry, we are there's a pushback on it. You can't really increase like that because things have changed, and that's just a few months ago. So market research is very important, and diversification of location. So why this is important is that when there's this thing that I just mentioned now, that we're having a pushback in the Dallas market, guess what? In our PA market, we are seeing a reason to increase more. We are adding more to what we already have. So different markets, different opportunities. So you don't have to put all your investment in one market. That's why we are in those two opposite markets, and we are playing with them because they align to what we are looking for. So diversification of location is important. It can save you from some risk. So when one market is doing bad, the other one is doing well and all that. So you can go like that. Invest in growing markets. Like some of our deals are in the tertiary stroke secondary market, and it's intentional. And because we are seeing some significant growth in those areas, and the pandemic made it. So we saw people leaving the cities and going to the rural areas to stay. And that has brought about growth. And if there are people there, you see companies coming in there. So in the secondary, tertiary market that we are in, we are seeing growth. Companies are moving down there. And so it's those kind of markets you want to be in, the ones that they're growing and or have the ability to grow. And if you don't do your market research, you will not know. So that's for that. Tenant risk. Before I go there, for that market that is growing, it's important that you position yourself before the growth is achieved. If you've done your study and you know the market is going to grow in the next 5 years, it's important that you quickly enter that market so that you take advantage of when the market is at its lowest, so that when that growth happens, you are reaping from it, and maybe that's when you're exiting or you are refinancing or something. So that's for that. So the tenant risk, right now we are seeing tenant unexpectedly vacate, causing lost runs and repair costs. So you need to evaluate your tenant risk. Like some of you know, one of our deals as a student housing, we had to reevaluate the tenant risk. It was high in turnover. That means every year the students will leave and we'll have to renovate the property with about 100,000 or more. And that is a risk that if you don't factor into your budget or into your underwriting, that can throw you off. Typically, and turnover cost is not that high, but because it's student housing, it's like you're doing a renovation on the house. So these are risks you need to look at. Tenant risk, like I said, what is happening now with the new president now on that's coming in, you need to start reevaluating, screening your tenants. If you were screening them maybe you were not checking their status and all that, that might be something you need to check. If you were not checking their job, you need to ask them what's going on with their job. Do they even still have a job? You need to start asking questions. If their credit score before was maybe you are accepting 580, like for two of our properties, we're accepting 580 as the limit. Last week during our meeting, we just increased it to 650. That means we don't want anybody that is below 650 on that property because of the risk now involved. So these are things you want to do. And the reason why you're doing that is to avoid delinquencies, vacancies, and bad age receivable, bad debt. You want to avoid all that. And then offer competitive amenities. This is a time you want to keep your tenants. You want to now bring in things to retain them. Amenities, maybe your neighbors, your competitors have swimming pool. You might want to do that, or they have grill area. You might want to do that, or they have a washer and dryer set and center, laundry room. You might want to do that. So you need to know what your competitors are doing so that your tenant will not leave your property and go somewhere else because they don't have the amenities that will keep them there and all that. Then your property manager must be proactive. Like one of the things our property manager is doing is that they are engaging the tenants to know how they are doing. And in the process of knowing how they are doing, they're asking them indirect questions about their job. Is everything going on well? And they're doing that as an intentional question so that you know who is leaving. And they're asking questions like, are you traveling out for the Christmas holiday? Are you coming back? These things are intentional. It's a very friendly question, the way they ask it, but really it's for us to take some decisions. So you'll need to have a proactive property manager on site. Operational risk. This one, I cannot ever overemphasize the importance of having the best property management company. This one alone can kill your deal entirely. Having the wrong property manager, not just having them to stay too long is as bad itself. So if you realize that you got a bad property management company, the earlier you take them out, the better for you. So you don't want to leave them to stay an additional 1 month or 2 months or 3 months, because the more you do that, the more your property is dying. And guess what? Remember I said something. Your KPI, when you're monitoring your property, it starts from the weekly. So if things are happening every week and it's bad, it will trickle into the monthly. And before you know it has affected your 1 year plan. So you want to avoid that from happening. And so that's why I'm emphasizing that the earlier you take them out, the better for you. if you can remember, before we asked our property management company to leave, they only stayed for August, September, October, for 2.5 months.
Yeah.
But the error that they did till now,
Oh
we are still
Lord.
feeling it.
Yeah.
Just 2 months and a half. The mistakes they made affected our 1 year returns significantly. If not that,
And the time we had to replace them was that critical window where we
exactly.
also needed to, it was just,
Exactly. Thank you.
yeah.
The time we replaced them was the time where you don't replace property management company, because that was the holiday period. And that was a period we're renewing for the new year and all that. That was a very risky time to do that. But anyways, we just had to do it, but it affected us. So you don't want it. Once you notice they're not doing their job, fire. Don't give them that wiggle room. If not, it might affect your entire returns for that year or even everything. So you just want to be careful when you're doing that. So I have 3 more to go and we can ask questions if we have. Financial risk, rising interest rates, increased mortgage payment. You want to be sure of the loan you are getting, like I said. You also want to keep reserves. You have to keep reserves because we are seeing insurance going high. We are seeing property tax going high. Somebody brought a deal to me. I wanted us to partner on the deal, but guess what? Actually, the deal was good, but I left the deal because of the tax returns. The tax return was not, I said tax returns. The property tax was not properly accounted for. And when I mean it was not properly accounted for, I mean that we called a tax specialist to give us a projection of what the tax will look like. And based on that, they did not account for that alone. And they were just assuming that, no, it's not going to happen. And I'm like, oh, no, it's going to happen. If the tax person is telling you this will happen, I rather go with that and know that maybe in the future it doesn't happen, but I have reserve for it, than not even having that reserve and it happens, then I'm in deep water. So based on that, I had to withdraw my steps backwards. So you want to be careful about the debt, the reserve, and the underwriting must be conservative. I see people doing their rent escalation, that is, they're projecting that next year they're going to increase rent by 5%, by 8%. I've seen 14%. I saw 14% 3 weeks ago, and I'm not joking, guys. 14% rent increase for 2025, 2026, 2027. I was like, really? So there's a 14% and everybody is not running to that market. Why are we not all there? So, and the market did not tell me so. And regardless of even if the opportunity is there, be conservative. Why are you not saying 7%? What if you're not able to achieve the 14%, which I know is unlikely for you to have that? It's only a few markets, and it's rare, So I'm not saying it's impossible, but not even in this period. That was too aggressive, very aggressive, and no. So legal and compliance risks, tenant sues over legal violation. So we had, you also want to be sure that your apartments are up to code. There are some tenants that know their rights and they're looking for every wiggle room not to pay their rent or to sue you to get money. So you have to be sure that you're in compliance with it. There's a tenant, I don't know if you know this, one of the property, the tenants did not report to the property manager that their bathtub had some issues that was like an hazard. They did not report to us. They went straight to call the city. They called the city and reported. And that was like, and the property manager was like, but we're here. Why didn't you tell us? We're not in your house. We don't stay with you. If you don't report this, how do we know? And the city, the good thing was that property manager and the inspector that comes, they've created some rapport. And the lady said, I'm giving you 24 hours to do it. And the property manager just called me and said, Bibi, and we need your approval. Should we do it? I said, go ahead, please hurry up, do it. It cost us double because it was an impromptu repair. But we had to do it because some tenants are crazy. So you want to be sure that your property is up to code and your reputational dam, everything. So you also want to consult with a lawyer if you have to. obtain comprehensive insurance. We are seeing things happening in different locations, like the hurricane that happened in Florida and in North Carolina. These are real issues, guys. I don't know how some insurance companies are even ignoring it. Some of them will not respond until many years. Some of them will have to go to court. And if you did not, some of them are saying you did not, your insurance does not have flood insurance. So I'm not going to cover it. But the place is not a flood zone. Why should I get a flood insurance? But flood from nowhere just came, and now they're in that. So you need to have a comprehensive insurance. So the last one is as a strategy. The market softens, making it hard to sell at a profitable price. So like I said, this is not a seller's market. Most people that are selling, some of them because they've gotten to the peak, they need to exit. Some of them are selling because they are not profitable. Some of them are selling because their loan is due. So most days we are seeing are falling under those categories. And this is the time for anybody to buy and not actually the wise time to sell. So we also need to plan multiple exits. Like the deal that we currently have, we have multiple exits. We have an ability to refinance, to sell if we want. We have also the ability to maybe to do 1031 exchange, different exit strategies that we can do on it. So you need to have multiple exit strategy in case something happened. And you need to understand the cycle. The market cycle is like this, just like the name implies. You need to know when the market is up on the cycle, what you should do when it's by the side, and when it's down in the lowest point, what are the things you need to do? And remain flexible. Yes, you have your business plan, your goal, and all that, but you need to ensure that your business plan is also flexible. So in case an opportunity comes, you take it. Or in case you see problem coming in front, like if you see that your market is going to decline, let's say you bought the location was good, but you did a market research and you're seeing a decline that will happen in some few years. Like some markets, they might experience some decline in construction. If construction workers are leaving, they might have some properties might face some challenges, so you want to understand and be flexible and just take advantage of the opportunity and run if you have to run. So I think in summary, that is the end. It's just for us to identify the different motive. There is no investment that does not have its own risk. But the moment you're able to understand them and know, and the moment you're also able to mitigate them, then you're good to go. So thank you, everyone. If you please, over to you.
Amazing. All right. I was just reading what, oh, Drew, if you're still here, I think that was AI speaking. Let's see. Dara had a question. What percentage of operating reserves should be considered in underwriting?
Yeah, so there's no fixed amount. It just depends on the deal. So typically the seller will take a reserve. The seller takes between 3 to 6 months reserve on the insurance and taxes, and they hold on to it. Sometimes for the entire period of the deal, and sometimes they give you a clause that if you are able to consistently pay your bills, nothing happens, after a few years, they'll give you back and all that. So that reserve, you should have it. And you should also have your own reserve for emergencies, for capex, for different things. So it's not one size fits all situation. It depends on the deal and the risk involved. So for a C class, I will advise more. For an A class, maybe a little, just normal. For a B class, more than an A class. And the reason why I'm saying that is because an A class property is brand new or almost new. The tendency for things to break it's not impossible. It happens, but not as frequent as an older property and all that. So you might want to reserve more for an older property. But in a case whereby you are doing a lot of capex, that means you are replacing a lot of items. Fine. That means you have provision for that. But that does not negate the fact that you should not put some reasonable reserves down. at all. Yep.
All right, awesome. Other questions that anybody else may have in the group about mitigating, ask now before you go put yourself in hot water.
Drew Clinton, he said you're
Yeah, no, Drew was responding. He was responding to someone's note taker AI. I allowed note takers to come in and it
okay.
automatically must have said something.
Okay.
Yeah, so he was
It's quiet in
responding.
here. You all done.
Yeah.
I have a question.
Yep.
Maybe a little off the grid from underwriting, but as far as, trying to capture risk before it gets too out of hand, you mentioned somebody who didn't report the problem. They went to the city instead. Have you guys ever heard of maybe an attorney drawing up something for the tenants to sign, like specifically wording them not to do that?
No,
Say,
you can't. You can't do that.
no.
Tenants have their right, and landlords have their right. So you need to understand your right, and the tenants to know their right. Tenants know their right, really. Many tenants know their right, but they're just waiting for the opportunity to use it. So as a landlord, you are trying to be on top of it. Only few places you see landlords treating tenants very wrong. I went to a property to inspect. If I know you can remember that we saw a lot of roaches.
Yep.
So I went there wanted to buy the property. The LOI was accepted, but I was not ready to sign until I see the interior. So luckily for us, a tenant was outside, and the tenant came to meet us and was like, "Hey, I like you guys. I like." We were like, "Oh, that we came here to see the property, but they did not allow us. Can we see yours?" He said, "Oh yeah, sure. Why not?" That was the best thing that happened to us. We went there. The entire ceiling was down. The whole house was wet. The water from the first floor was dropping on the ground floor. Roaches was everywhere. Everywhere, every place, everywhere. They had three kids in that house.
Kids, yeah.
They would be eating and roaches would be around the food, would be climbing on the food. I've never seen such in my entire life. And I asked the question, I asked the tenant, why haven't you, this is something like you're supposed to report it. And the tenant was like, I don't want any problem. I don't want any issue. I was like, what? This is bad. This is not the one you say you don't want any problem, you don't want any issue. But because we raised an alarm, the owner withdrew the property from the market and did some repairs. Lately, I just saw the property out again, so tenants know their right, and you can like shun them not to talk and all that. Just do your own part. It's pretty easy. Ensure that your house is in compliance, the codes are met. That's what the maintenance and the property management company is there for them to go around and inspect and see anything that is breaking or something that is going to cause an hazard. But just that some landlords are just looking for more money and they're not maintaining the properties. That's the problem.
I see.
Great question. Any others? Going once. Wow, you guys are amazing asset managers to be. All right. You're amazing asset managers in the making. We do have a WhatsApp group. If any question comes to mind, toss it in there. I put the WhatsApp group in the chat. And then, since you guys don't have any questions, why don't you share a takeaway from something you've learned in the WhatsApp group about this series that we just had now? Cool. Cool. Well, we will be back next week. Remember, next week is in 2 weeks with another asset management series. Thank you guys for coming, and we will see you then. Thank you.
Thank you.
Thank you all.
Appreciate it.